Great.
It's showtime. Hi, folks. Today, we are going to pick up where we left off in the first workshop that we did on this topic in late July last year. That was called What is Protected Investing? And on pondering how to do so, we decided that it would be part of a series of workshops that we'll be doing moving forward, which is why we decided to call this workshop What is Protected Investing Part 2. Of course, makes the most sense, right? Now, if you enjoy this topic, then keep an eye out for more webinars that we'll be planning to do in the future on it. Now, lost it already. I'm messing it up already. Hold on a second, guys. I got to do something here. Get me off. I'm staring at my face. All right, move this here. Okay, with that said, we couldn't be more excited to be discussing this topic again with all you guys today. First, because we believe in it so much, but also because it's great timing to do so, since both the stock and bond markets are still in such flux as they were the first time that we did, which is still resulting in so many people wondering if there is another way to go about investing that isn't as risky, but can still provide respectable returns without locking in their money for long periods of time and not experiencing any penalties to do so. We'll just like we said last time, we'll be covering this topic, and if that's you, then you're really going to enjoy this topic today. Also, folks, we are also super stoked to have back with us to discuss this even more investment strategies that utilize this method of investing, as well as some that we discussed in our part 1 workshop as well from ZEGA Financial, the foremost experts on protected/hedged investing today in our industry, and with whom our firm has been working with to allocate portions of several of our clients' portfolios to various ones of these strategies. It's their Director of Business Development, Mike Puck. How you doing today, Mike?
Hey, good, Brian. Thanks for having me back.
Well, folks, we couldn't be in better hands than to be learning about this type of investing from Mike, because he's not only a chartered retirement planning counselor who formerly worked as a trader in New York on the New York Mercantile Exchange, where he traded commodities, and as a vice president at J.P. Morgan Chase and a senior financial consultant with TD Ameritrade. But he's also been working with ZEGA Financial in one capacity or another for many years, teaching people and helping oversee protected/hedged portfolios for I believe it's the last 8 years. Thanks for being with us here again to help us wrap our heads around this topic again, Mike. I just couldn't thank you enough for agreeing to come back with us, pal.
Sure. Yeah. Well, thanks for having me, Brian. I think one thing I'll add to that is, I started off as a trader on the NYMEX in New York, and I traded options. So a lot of people have questions around options and how they work. Are they protected? Are they aggressive? And there's a lot of different ways you can use them. And so starting out trading options, one of the more complex strategies out there, I think gave me a good base back in 2007, 2008, right during the financial crisis. Horrible time to get started in the financial markets, right? But either way, I got through it on Wall Street, and now I think you're absolutely right. We are one of the leading experts when it comes to this type of trading. So I'm excited to share that information with you guys tonight.
We're going to be talking about a few of the other types of strategy. I've been like on the edge of my seat since we did the last one, to really get more of what you guys are doing, because honestly, I'm still trying to wrap my head. I'm as much a student to this workshop as anybody else here tonight, and so I'm as excited as anyone, believe me. Also, I hope that you guys can tell that because of all of that, this is a really special workshop that we planned out for you today, and one that we think that will not only be educational but also enlightening. Hopefully, we feel like hopefully most of you will feel that way. So with that said, I want to thank each of you for attending today. My name is Brian Dougherty of PLC Financial Solutions. I'm your regular host for it, along with my beautiful, wonderful partner in business and life, Rachel Dougherty. Say hi, Rachel.
Hey, everybody.
Hi. Rachel will be our moderator for it again, as always, and she will be handling all the comments and questions as we go along. So if you have any questions or comments, you can put them in either the chat or the Q&A boxes, and she will reply to them in kind. Now, before we get started, let's take care of a few general housekeeping things. First, if the screen is not big enough for you to, you can click on what at the top of your screen, what's called the view options drop down, and you should be able to enlarge the screen so that you can read it. Also, you'll see that there are two boxes at the bottom of your screen. One's called chat, it's for your comments, and another called Q&A for your questions. Please use them accordingly. And again, like I said, Rachel will respond in kind. I'm sure that many of you have questions or will have questions about the material that we will be covering today. But since we have a good bit of material to cover and only an hour to cover it, I'm going to ask you to put your comments and questions in those boxes below, or you can even email them to us at info@plcfs.com. That's Paul, Larry, Charlie, Frank, Sam.com. If it's easier for you to do on your phone or an iPad while you're paying attention to the presentation on the computer. And at the end, we will be staying for some extra time to cover as many of them as possible. However, if we don't cover yours, we'd be happy to answer it by either email or even a 15-minute Q&A phone call scheduled for another time. And Rachel will be putting that link up at the end. Next thing, this webinar is being recorded and it will be sent to everyone who is attending tonight. So don't worry about missing anything. You'll have plenty of time to check it all out again at your convenience. Also, because we want to make sure that you're all paying attention, and because we'd like you all to have some fun as well, before we answer any questions, we have a 6-question quiz, as always, for you at the end. And the first person to answer each question correctly inside the comment box or chat box will win a $10 gift card to a store of your choice. So make sure you have your handy dandy notebooks and to jot down any brief notes related to some of the special bullet points that I point out along the way. All right, now I'm trying to get this here. Okay. All right, finally, it is my obligation as a financial advisor and a fiduciary to inform you of our RIA's disclaimer statement, which is that our investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor, and we only transact business in states where we are properly registered or are excluded or exempt from registration requirements, and that the SEC registration is not an endorsement of our firm by the commission and does not mean that our advisors have attained a specific level of skill or ability. And most importantly, all investment strategies have the potential for profit or loss. So now that we got that over with, I have one for you as usual. This is going to sound familiar to you, Rach. So what do you call a duck on drugs? A quackhead. I told him I was gonna. He brought it up to us earlier in the week, that joke again, and I remembered it. And I liked it the first time I heard it, so I stole it from him again this time. All right. So of course I'm gonna say, like I always do, I'm not gonna quit my day job. All right. Now, so who is ZEGA Financial and what are they all about? Well, to start, they are a registered investment advisory firm with $636 million under management, with an average client balance of $1.8 million. They were founded in 2011 with the philosophy and purpose of utilizing options investing offered to the general public as a different way to invest where risk can be mitigated and returns still exceptional. They've been recognized as expert investors by both Fox Business News and the Wall Street Journal. Also, several of their models have been awarded 4- and 5-star ratings by Morningstar, and they are the buy and hedge retirement, hypos conservative, Z-Big IRA, and Z-Big leveraged portfolios. And we'll talk more about these later on. They are claims compliant by the Global Investment Performance Standards, which are a set of voluntary standards used by investment managers throughout the world to ensure the full disclosure and fair representation of their investment performances. The main principal and CEO is Jay Pestrichelli. He is a financial advisor and former online product developer at TD Ameritrade. He is also the author of the book, which I read, called Buy and Hedge, the 5 Iron Rules for Investing Over the Long Term, which is available on Amazon, which is where I bought it. Also, a couple of quick experts from the first couple pages of the book that I think really stood out to me right away are: 1, understanding risk and reward is their passion. And 2, that risk is what you take on. Return is what you plan for. And that's why they used advanced option strategies to take profit while protecting from volatility in the market. Don't forget that. Volatility in the market. We're going to talk a ton about that. Aren't we, Mike?
That's right. We're definitely a volatile market this year.
Absolutely. And we're going to give everybody the reasons for all that in a little bit. Finally, ZEGA is one of the few options-based money managers that offer their services to the general public directly through other RIAs and IARs like myself, who have a proven track record of success in doing so. Mike, anything you want to add to this here?
Yeah, I just think there's a couple noteworthy things that you mentioned. We're really proud of our Morningstar rankings. A lot of you may have heard of Morningstar before. It's a 5-star ranking system that ranks SMA strategies as well as mutual funds and ETFs. And we're really proud of, we have a number of 4 and a number of 5-star strategies that are available through Brian and Fusion Capital Management. And claiming GIPS compliant, right? We get audited every year. I mean, I think that's something that a lot of firms don't do. We're audited every year. Our numbers are audited. They're official. They're net of all fees. So if Brian ever shows you a fact sheet or you ever look something up on our website, just know that those numbers are fully audited and they're GIPS compliant. So we're really proud of checking those boxes, and they help our firm become better. And we're really just excited to be one of the top players in the option space in the market.
And it's voluntary, the darn audit.
That's right. That's right. It's a voluntary system. You don't have to do it. It's a lot of work too. That's the picture of our founder, Jay Pestrichelli. If you talk to him and ask him about GIPS compliance, he'll probably complain about it the whole time because it's a lot of work for our team and our compliance department. So it's an extra kind of feather in the cap that we do to give everybody comfort and credibility with our firm.
Absolutely. Peace of mind. All right. So let's talk about how protected and/or hedged investing works. First, it utilizes one of the least understood techniques in investing. Bullet point. I'm jumping right into it, Mike. I'm jumping right into it. Bullet point number 1. Come on, get your notebooks out. Jot this down. I know you're going to want to remember it. Okay. To use stock options, which is definitely a little bit complicated. So if we say, what type of techniques do hedge / protected invest, or what type of instrument does it use? It uses stock options. Stock options, folks. Mike's going to get into talking all about all the various ways that they do that, but don't forget that. Bullet point, stock options, the investment. I mean, the instrument. Okay. They're a little bit complicated, but I want to emphasize that that does not actually mean that it is riskier or speculative because it's complicated. For some reason, people have somehow equated the two. And the truth is that it is exactly the opposite of that, because stock options were created in order to reduce the risk of investing, not increase it. So let me give you a basic example of that. Many times we hear about employees receiving stock options instead of the actual stock in a company from their employers for various different reasons. It could be a bonus or a part of the retirement package, etc. The basic idea is that that employee, through the ownership of that stock option, now has the right to purchase their company stock at a certain reduced price in the future. It will happen something like this. If the designated price of that stock that they are guaranteed to buy, also known as the strike price, is say $20 a share, and in the future that stock becomes worth $100 a share, then that employee can then exercise that option. They will be able to buy a $100 stock for $20 a share. If they buy the stock, then immediately sell it, they will make $80 on each share. If they were given 100 shares of that at a $20 strike price, they end up paying $2,000 for a $10,000 worth of stock. Does that sound like it is a risky stock purchase? That's what I want to get across. That's part of what I want to get across. Just on I know there are a lot more complicated things to look at, and Mike's going to talk about some of them, but that's just an easy understanding of one of the most basic ways to use them. You agree with that, Mike?
Yeah, I think that's a really good example. And a lot of people, like you said, you really hit the nail on the head. A lot of people equate options to being risky, but not the way you explained it just now, right? As you're getting an option to buy a stock at 20 bucks. If that stock price goes above 20 bucks, you make money. It's that simple. And a lot of what we do in the option stuff we're going to talk about today, it's not speculative. It's actually very protective.
Exactly. That's what I wanted people to understand that. And you'll get into it. There are different ways that it's used where this is kind of a hedged situation, you might call it, right? Right. And then there are just protected strategies where it's not hedged. And we're going to talk about that in a little bit. But the truth is that they really don't even need a company to give these stock options to them. Anyone can buy them and do the same thing themselves. Of course, the stock value could go down too, which would render the stock option worthless after a certain amount of time, because this type of stock option that you buy yourself, they have time limits on them, where maybe one with a company doesn't. So again, like I said, they can be a little trickier in real life, but if you know how to use them like ZEGA does, you can exercise it in very much kind of the same way. Would you agree with that, Mike?
Yeah, I think that's right. You know, a lot of options have time limits on them. Some within companies may not. But yeah, so you have to be very careful, right? You don't just want to go out and trade options on your own without having a little bit of knowledge, or at least a base knowledge when it comes to them, because they can be a little trickier. But the idea is we use them in a lot of our strategies for protection. So we're looking at them for protection. We're looking at them for income. You know, there's a lot of different uses for options, and we'll get into it.
Absolutely. So it's also worth noting that they do have a cost related to them too when you do it on your own, and they will usually cause your return to be reduced based on that cost. But since they sell for a fraction of what the stock usually costs, the reduction in return is usually well worth to protect against the market losses that they can help to avoid, or for the gains that can be made if the market or the option goes up in the future. So, all right. So now we're going to jump in a little bit to talk about volatility. So, Mike, this is your slide. You want to jump in on this one?
Sure, absolutely. So here we go. Perfect. So this is a great slide that shows that shows how hedging works, right? So hedging or protecting or a buffer or anything that protects your portfolio from going down, right, is actually going to be helpful in the long term. And so if I read this chart left to right, let's look at the left side. And so we want to look at the red bar first. So if the market drops 10%, well, to get back to even, what you need to make is the green bar. So in this example, right, market drops 10, we need to make 11. Now, let's move left to right here. The market drops 20, you need to make 25%, right? And as we keep going, if the market drops, it's a little blurry for me, but I think it might be 25, you need to make 33%. So think about that in terms of dollars, and we'll make it really, really simple. Let's say you have a $100 bill, right? And you lose 50%. Well, now you got 50 cents, right? So how do I make back to that $100 or excuse me, I have $50, not 50 cents. So, right. So I have $100, I lose 50%. I now have $50. Now I need to get back to $100, right? How do I do that? Well, I need to make 100% of the current value, which is $50. I have to double my money to get all the way back to $100. So if we go to that far right example here, that's exactly what I just mentioned. You lose 50%, you need to make 100% to get back to even. So when you're thinking about investing, if the market goes down like last year, remember the market dropped 18% last year. That was a pretty big hit. So if you had a very aggressive portfolio that was maybe down 25 or 30%, you're going to have to make 43%, or you're going to have to make 33% to get back to even. But if you had a portfolio that was hedged or buffered or protected, if you only drop 10%, you only need to make 11% to get back to even. Or if you drop 15%, right, maybe you only need to make 22% to get back to even. So the idea is we're smoothing out the volatility of your portfolio, and we're smoothing out the protection of your portfolio, so you don't need to really hit home runs all the time. By building in protection of your portfolio, you're smoothing out the ride, and you don't have to hit those big years where you make 20, 30, 40% in the market. You're not going to need those. You're going to consistently be able to build your portfolio higher because you're not losing as much in the down years.
Absolutely. I mean, nothing. I think this slide really has a lot of impact, just making the point that you see how much volatility hurts your portfolio and what it takes to get back. It takes a bit more, sometimes double, to get back to where you were. And the market isn't always going to perform in a way to get you back in a year's time.
Right. Yeah, absolutely. And I think we're already seeing that this year, right? And we saw that in 2001. If you guys think about the tech bubble, right? So we had a down market then, 2001, 2002, 2000, 2001, and 2002. So 3 years in a row, we had a down market. I mean, and that's where we've talked about, you may have heard this term before, it's called the lost decade. From 2000 to 2010, if you had your money in the S&P 500, you made actually zero. You know, if you had $1 million in the market on January 1st, 2000, well, January 1st, 2010, you still had $1 million in the market. And that's because of this example right here. If you lose money out of the gate, or you have a big loss at your first couple of years of investing, it takes so long to get that money back. And this chart shows exactly that. So you want to focus on protecting the portfolio, and we're going to go over a couple strategies tonight that will provide protection or alternative income that's really not correlated to the S&P 500. So if the S&P has that big down year, last year is a great example of that, right? You're not going to lose as much money as the market if you add some of our strategies to your portfolio. And because of that, you're not going to have to really swing for the fences or hit that home run the next couple of years. Because you're protected, you're going to be able to build the portfolio faster than the person that loses that big amount of money in a big down year.
Absolutely. Now, before we do, we're going to get into them soon. Let's just expand on this a little bit with the volatility, just a little bit more, because I really like driving this point home, because it just Every time I do this, it reiterates to me why I believe in so much in these things that we're talking about and the portfolios that can help this to reduce this. So that being said, the major reasons why to utilize protecting investing today are, I don't think I have to say this, but I'm going to, right? Volatility is back in the market, both the stock and bond markets. And the bond markets don't even let's not even get into that right this second, because that's actually gotten complicated. But they're back. They're volatile in a big way. Bonds maybe in the biggest ever. So so far, well, as of last year, they saw 110 or no this year. No. I'm sorry, I'm getting ahead of myself. Last year we saw by the time we had done this last year, 10% increase and 10% decrease just in the first quarter. I did update it. Just in this year, we've already seen 10% decrease and 10% increase in the first quarter, right? And that's the point I wanted to make. Now, last year, the market saw corrections of 10% and 3 times, or 4 market corrections of 10% and 1 of over 20%. But just in this year, now we're almost out of this quarter, right? We've already seen 10% increase, and we've already corrected down off of that already 10%. Already. Okay. Now, the truth is that volatility in the market is always there, and it will always cause compounded returns to be lower than in investments that are exposed to less volatility. We'll show you some good examples of that. Bullet point two. Come on, get the notebooks out. Get them out. Write this down. To reduce volatility is the bottom line of why you want to use a hedge/protected type of investment. And really, I also include tactical in that as well, because the concept is to reduce volatility with tactical investing as well. And that's another kind of favor. I know it's a different topic from tonight, but I do a workshop on that as well. And that's kind of near and dear to my heart as well. But don't worry, Mike. ZEGA is still, it's winning my heart over more and more every year.
Sure.
More and more. So to reduce volatility is the #1 reason why you want to use hedge/protected investing, and tactical for that matter. Okay. Now let's take a look at another. This is going back a couple of decades, right, Mike? So
Sure. Yeah.
Right.
Let's go back to 1991.
Yeah, jump into this one, please.
Sure. Okay. So yeah, this is a great chart. And what's important to know here is this is on volatility. So there's a way that investors and analysts track volatility in the market. And so we use what's called the VIX, VIX. You may have seen that before if you go to CNBC.com or you watch CNBC on television. They have this quite a bit. And so the VIX tracks volatility. So if you think about the market last year, and Brian just mentioned this, there's all these pullbacks, right? The market goes up and then it pulls back 10%, and then it goes up again and it retests the lows. And you hear analysts talk about this quite a bit. I looked up some numbers here while we were talking. Even this year alone, right? The stock market's actually slightly up about 3%, and the bond market's up about 1%, which is great compared to if a 1-year look back. Still, if I look back today, back to March of last year, the S&P is still down 14%, and the bond market's still down 7%.
That's what I'm talking about.
That's what I think Brian's trying to drive home on the last slide there. That's unbelievable, right? As the bond market down 7%. It actually ended last year down 13%. I think it's the worst year of the bond market in 100 years. So actually, that just shows that volatility is here to stay. So click one more or two more, Brian. So those little brackets pop up. So this is really neat, and this is how we track volatility here. And what the red brackets show on the bottom is times of low volatility. And what you can see is just like anything else, stocks or bonds or trends, really in anything. the market moves in these phases, and the red brackets are times of low volatility. So you can see from 91 over to like 98, 99, we had a low volatile market. Market actually kind of slowly trickled away up. It had a great run that time frame. The blue brackets are actually when periods of high volatility happen, right? So we get the market up and down. So just like any other trend in life, they move from low volatility to high volatility, low volatility, high volatility, and so on. And so what happened from 2013 on to about 2020, a little before COVID, actually, right? We had a very low period of volatility. So our long period of volatility, right? The market just really trickled along. It did very, very well. Technology did well. The S&P as a whole did well. Dividend stocks did well. You had some shakeups here and there. 2013, Brexit, things like that happened. But really what's happened since then is you can see that last blue bracket there, which we don't know how long this is going to last. But what we've entered into is a period of high volatility. So you can see the spikes there. And now here we are. We've left that low volatile market. We're in that high volatile market. And we don't know how long this is going to last. Maybe it's going to last till 2024, 2025, maybe 2026. Maybe we have something like the 1920s where it's kind of not a Great Depression, hopefully, right? Knock on wood. But you have kind of a market that bounces around. It doesn't really get a lot of growth for a number of years. And you can already see that this year, right? The market was up like 7% in January. And now February, March, we've pulled all the way back. And now we have all these banking issues that are out there, which are scaring the market. And they're kind of moving over to some of the technology companies, the venture capital markets, things like that people are concerned with. So, right, what the market hates, and it absolutely hates this, is uncertainty, right? So uncertainty creates volatility. So ask yourself this question. Are you certain that the banks are all going to be good and we're not going to have any more problems? The answer for that is probably no, right? We don't know if the banks are all going to be okay. Now, I think that these are pretty isolated events, but again, they're creating uncertainty. If you have uncertainty about it, so does the market. So that creates volatility. And what happens is now you get those big up moves, market's up 3 or 4%, then it's down 3 or 4%. So that's what we've entered into, is a period of high volatility. And I don't know how long it's going to last. Nobody really does. We just have to watch the market. But what you can do is you can implement strategies in these periods that protect you or make you money in these types of markets, so you are protected if the market continues to drop. So we're in a high volatility market. That's what the data tells us.
Absolutely. And the thing I think people need to understand too is usually they're related to each other. Pretty much the bond market, what the Fed has done, has basically trickled into the banking market and caused major problems because those banks were investing in those bonds, right?
Sure.
And those bonds, they were going into long-term bonds, which what was the long-term bond market? What were the corrections like for that last year, Mike?
Yeah. So, just real quick on the banking crisis is, what happened is a Silicon Valley Bank and a number of other banks, they purchased 10-year bonds that yielded 1 to 2%, right? And so when interest rates started to go up, those portfolios started to mark down. So not to get too into the bond market, but as interest rates go higher, longer term bonds lose value, and people needed money because of Silicon Valley Bank specifically. They had a lot of tech and venture capital firms that have a lot of cash flow needs. So what happened is those companies needed cash flow, and their money was locked up in long-term bonds that were losing value because of the interest rate hikes. So
And the Fed's not
kind of a smaller regional bank issue, but you're absolutely right, Brian. That's really what created a lot of uncertainty in the market. And so they had those long-term bonds that yielded 1 or 2%. Obviously, interest rates are higher now, so those bonds marked a little bit lower.
Yep, they're lending the money out, keeping the spread, right?
That's right. Yep, absolutely. And I'll tell you this, Silicon Valley Bank is always solvent. All that they did is they took a loan from the government. So it's not like the bank actually failed. They still had plenty of money, and their money would make everybody whole. It just is going to take time.
No, absolutely. And it wasn't like they did anything wrong at all.
Right. They didn't do anything wrong. Well, they could have managed their bond portfolio better. So,
Yeah,
that's one of the debates. But, again, they're going to be made whole. But going back to this slide is a lot of that created uncertainty in the market. And so what happens from there is you get volatility, right? That's why we've seen the market decline over the past couple of weeks.
right. So point being is the Fed's not backing off yet. So and if those things are involved, this volatility could hang in for a little while longer.
Yeah,
right?
absolutely. We could see a volatile market. I think we could see a volatile market for another year or so.
Yeah, through 24, maybe even. That's what the Fed's saying. They're probably not going to back off till after 24. So anyway, just think that's interesting because when you look at these pool brackets, every single one of them, there's multiple years there.
Yes, yeah. These volatility or these times of volatility, they're not short, right? They're not a year or 6 months or 3 months. These things can last 5, 6, 7, 8, 9, 10 years at a time. So we've already entered a stage of high volatility, and we'll see how long it lasts. Maybe
Hopefully
another year, maybe
short.
another 3 years.
Exactly. Okay, so all right. One last slide. This is my favorite slide on volatility. I can't let a presentation go by without doing this one. So as you can see, when it comes to how market volatility has historically affected investment portfolios, let's take a look at a hypothetical comparison of two different portfolios. In this slide, in the upper part of it, you can see this clearly when you compare the two wavy lines that are representing two different portfolios on the top graph here. The orange wavy line, which represents the more volatile portfolio, has a range of plus 25% return to a negative 15% return in any given year. And the gray wavy line has a range of plus 15% to negative 15% return a year. And even though they both have an average simple return of 5% annually, the less volatile portfolio produces an actual return of 42.5%, which is 5.3% compounded annual return over this 8-year period, versus the orange portfolio being at 27.4% actual return, which comes to 3.4% annual compounded return when you look at the actual dollars. Folks, this is a difference of almost 2% annually. So this is a very big deal over the long run. Bullet point 3. Come on, get out your workbooks. Write this down. Compound dollar returns are more important than average numeric returns. I'm going to explain what that means. Compounded dollar returns are more important than average numeric returns. Also, the spreadsheet below with the green line at the top of it shows the numerical breakdown of how the two portfolios arrive at these different compounded returns. I created this spreadsheet just so I could actually see how this worked in dollars. And I must tell you that I was completely flabbergasted when I realized it several years ago. So at the end of the day, when you're reviewing your portfolio, making sure that it has a good risk return profile that minimizes your portfolio's volatility is of the utmost importance when it comes to maximizing your portfolio's potential returns long term. All right. So now that you have a good idea of why it's so important for your portfolio to have a good risk reward profile that keeps its volatility under control, you now know one of the main reasons why our firm has preferred and gravitated towards both the tactical and protected/hedged investing approaches over the traditional static asset allocation approach that has dominated the investment world for so long. The bottom line is that the main priority when it comes to tactical and protected managed portfolios is to minimize volatility, which in doing so also mitigates the risk of the portfolio drastically as well. These types of investment strategies have been used at the institutional level for many years, but it's just become more acceptable or more accessible to the average investor through different third-party money managers like ZEGA Financial over the last 10 or 15 years. Mike, what are your thoughts on this? I'm sure you've seen this before. Just so we drive one last point home for volatility.
Yeah, this is a very interesting chart to look at. I think what the important takeaways here are, it's just a less volatile portfolio over time does better, right? That's the idea. And again, it's if you have
may not be as sexy, right?
Right. It's not, you're right. It's not as exciting. And you can see, that the orange line is, up 25%. Wow, that's great. If you think about it, of course, everybody wants to be up 25% every year. But with those higher returns comes a lot higher volatility. And what all the studies show, and this one in particular shows, if you limit that volatility and you protect more on the downside, right? So just think about, lower lows or higher lows. You want higher lows, right? You don't want your lows to be so low. You want them to be a little bit more streamlined. And if you can do that, that's going to equate to better performance. It might not feel as exciting as, hey, I made 25% this year. Yes, I get it. That's really exciting. And we all want to do that. But again, if you have that more steady portfolio and you might miss that 25% plus year, and maybe that year you only make 15%, that's okay, because as long as you're having more consistent returns over longer periods, you're going to have better overall returns in your portfolio.
Absolutely. Absolutely. Okay, so now let's talk about how ZEGA does what they do when it comes to using both stock options and the other investment vehicles to create their various protected/hedged portfolio models. Each portfolio model has a different approach and goal, meaning that some correlate with the market and some do not. On top of that, each suite of portfolio models also have different risk levels related to them. Mike will explain each of the portfolio models that we're going to focus on more in a few minutes. Secondly, when it comes to each portfolio model having different risk levels, regardless of whether they correlate with the market or not, this is accomplished both through the implementation of different investment types, ranging from short duration government bonds, the actual bonds, not funds, to the use of bond funds, to equity-based funds, and even to the ownership of individual stocks in some of their portfolios. Now, when it comes to the use of stock options in their strategies and how they contribute to the portfolio's risk level, this can come from either how often the options are traded or the different type of options, plural, that are being implemented in the strategy. Some use basic call options to hedge or / protect the investment, and others use put options to generate income as return for the portfolio, and some may actually use both. Finally, they now have three main model types, 4 if you include the Zoom model, which is actually 5 if you actually, because you were just telling me the dividend plus is also under the others. You consider that.
Yep.
So 5 if you actually include Zoom and dividend plus, which is not which we're going to talk about, the dividend plus, which is not available. Zoom is still not available to us, Mike.
No, I think I'll have to check on that. I'll have to check.
Okay, you check on that. I hope it is. And yet, each of them are standalone in a single strategy mode. So each suite of portfolios includes multiple models that are designed according to their risk levels and their purpose. The 3 main model types are the ZEGA Buffered Index Growth, otherwise known as ZBIG model. The second is the High Probability Option Strategy, also known as High Post models. And the third is the ZEGA Buy and Hedge models. otherwise known as the buy and hedge models. Doesn't have a cool nickname. What happened with that? Come on, Mike, you guys gotta get on this.
Right.
Also, I must point out when it comes to these models, is that some of them, namely the ZBIG and the high post models, have submodels within them that are designed to produce as much income as they can. And these are the ones that we will be focusing on more during this workshop. Mike, what would you like to add to what I'm talking about here?
Well, I think for this particular slide, it's important to know that these strategies are standalone strategies, which mean, you have to open a separate account to use these strategies. They're not, they can be grouped in with other accounts. And that's because we run, like Brian said in the beginning, we run about $600 million. And to do that, right, is we build these strategies out, and they have to be kind of uniformed for everyone. So when we use these strategies, this is our very best thinking, right? Our thought is no portfolio left behind. So when we review these strategies, just know that you have to open a separate account, and that's a good thing because your account is in with everybody else. And this is our very best thinking when it comes to the different strategies. So Brian, if you want to go to the next slide, we'll show the different lines, and I'll cover each one of those, how they work.
One last bullet point number 4. Write this down. We will be focusing on these 4 ZEGA models. Write them down. The ZEGA Dividend Plus, the ZEGA Dividend Plus, the ZBIG Treasury, the ZBIG Treasury Income, and the high post conservative model, which we covered in the last one, but it was so popular that we decided to throw it in again. Okay, so now let me jump in to the next one. All right, yeah, so yeah, we can
Perfect.
do this for us real quick.
Yeah. So like Brian said, is we are think of us as 2 avenues when it comes, and there's really 3 if you'd like to, but really the 2 spaces where we think we can really add a lot of value are alternative income. And that's where that high probability option strategy on top is covered, right? We have aggressive growth, we have moderate growth, we have conservative and income. We're going to cover today conservative. Conservative is a very consistent strategy, which we'll show you, that just it has very consistent returns. Like I mentioned earlier, S&P 500 was down 18% last year. The bond market was down 13% last year, and our high post aggressive strategy was up almost 6% last year. So positive performance there. We'll show you the inner workings of that. And those all fall under alternative income. And the idea behind alternative income is that regardless of what the S&P 500 is doing, or the Dow, or the NASDAQ, or the bond market, these strategies are designed to make money. Now, it doesn't mean they're going to make as much money as the market. So if the market has a big year and maybe is up 30%, maybe we're not up 30%. Maybe we're only up 8 or 9 or 10. But that's okay, because if the market's down 30% or it's down 18% last year, right? Our goal is to just stay consistent and try to make that alternative income. So that's the first product line, is alternative income, and that's where HYPO's high probability option strategy falls into that. And if you jump down all the way to other strategies and look at ZEGA Dividend Plus, that also falls under the alternative income strategy. So again, this is an income-focused strategy, which I'm going to talk about. I'm really excited about this. We built this out last year with our investment team. It's done very, very well, and it's really focused on income. And we'll get into that. And then the other line, if you want to think about ZEGA, is a protected growth line, which could fall under our hedged equity, which are buy and hedge classic and buy and hedge retirement, or our buffered strategies, which are ZEGA ZBIG Treasury, ZBIG Treasury Income. There we have an IRA version, and then we have a standard leverage. We're going to cover Treasury and Treasury Income today because they're very protected strategies. But think about it as that's how we work, is either people that are looking for alternative income, so they're not correlated to the S&P 500 or the markets in general, and they're looking for income, or they're looking for growth, but they're looking for growth with a piece of protection. We're going to focus on the more conservative side today, as we get into ZBIG Treasury and ZBIG Treasury income.
Yeah, we're more on the income theme this for today than
Yeah, definitely.
growth. But it's because we spent so much time the last time. And is it fair to Mike to say the buy and hedge, the ZEGA buffered index growth, they're more correlated with the concept that I kind of with the example I gave in the beginning of the employee who gets the stock option, and it's kind of like protecting, what they're not the same, but
right.
Using the same.
Yeah, there's some similarities, right? There's some similarities there in the idea and specifically the buy and hedge, right? Is that we're owning the market, but we're hedging the portfolio. So if the market drops, you're designed not to lose more than a certain percentage, right? So if the market drops 30%, that's okay. We're not really losing more than 10%, right? So we limit your losses. And the buffered strategies as well, and specifically the one today, I mean, these are very conservative strategies, but if the market goes up, you get a nice piece of the growth of the market. So there are some similarities to owning a kind of a stock option, right? Because there's only so much you can lose if you own a stock option. But if the market goes up, there's a big percentage you can gain. So both of those strategies are very protected, but also give you growth if the market goes up.
Absolutely. All right. Okay. Now that you guys have a good general understanding of what the different portfolios that ZEGA has to offer and what they're all about, let's start taking a deeper dive into the ones that we want to talk about tonight. Starting with the ZBIG Treasury. First off, the name ZBIG, like Mike talked about or mentioned just before, it stands for the ZEGA Buffered Indexed Growth portfolio or suite of portfolios if you have it. Now, bullet point five. Come on, write it down. Did I surprise them? Did I sneak up on them? Okay, write it down. So, they both have the name Treasury, the ones that we're using today. And that is because the majority of the assets are invested in U.S. Treasury bonds, and the minority of them are in stock options. So we're going to cover the ZBIG Treasuries, and I'm going to want to know what Treasury stands for. Okay, and that's because they have mainly the bulk of the investment in Treasuries. So you want to talk about that a little bit, Mike?
Sure. Yeah. So think about these. If you've ever done an annuity in the past, these are these have similar type of structures, but they're not annuities. So that's the number one thing is none of the products or strategies that we talk about are annuities. But this one has a very similar feel when it comes to the protection of it. And what I want you to think about it, these are point-to-point strategies, which means you want to stay invested from the first point to the last point. And that's what that first bullet point says is they're targeted payouts of 24 to 36 months. Now, I'm going to jump around a little bit here because the nice thing is that even though they're 24 to 36 months, these are always liquid. So that bullet point number 4 right now is these strategies are always liquid. You can always pull your money out. There's no penalties. There's no surrender charges. If you have an emergency, if you put $200,000 of this and you had an emergency, you needed $50,000 the next day, no problem. You're more than welcome to take it. So what we do here, though, is we swap out all of the fixed income risk for U.S. Treasuries. So you're actually fully principal protected. So the strategy is protected by the full faith and credit of the United States government, right? So this is, I think, better than an annuity because, hey, annuity companies can fail. It happens all the time. Some of the big annuity companies have failed over the years, but the U.S. government has not. So what we're doing is we're buying U.S. Treasuries, and we're offering a certain amount of participation in the market. And it all depends where we get invested, but you own U.S. Treasuries and you own a certain part of the market. These are great for conservative investors or anyone who likes annuities but doesn't want to lock up their money. And they're also appropriate if you're in a state that maybe you can't buy any more annuities, even if you like them. Some states, Wisconsin's one. There's a handful of others that have that restriction. The minimum for this strategy is at least $100,000.
Okay, now let's take a look at this chart.
Yeah.
Here. So can you break this down a little bit here? Remember we had these
Perfect.
charts
Yeah,
last time?
let's show you how it works. So this first one, and this is even a little low, but this first one is called ZEGA Treasury. And what I want you to look at here is the red line is the S&P 500, right? That's the market. So what you can see is the dotted red line is what happens when the market goes up. If you move to the right, it goes up. If you move to the left, it goes down. The blue line there, ZEGA Treasury, this is how the portfolio reacts. And so first, let's go left. So let's say that the market goes down. Well, you can see there's no downside cap on this side, capture on this point. As the market keeps losing, if you're down 5, 10, 15, 20%, doesn't make a difference. You have a flat line. Now, remember, to get that downside protection, you have to make sure you are invested at least to the second point, from the first point of investment to the second point, which is the end of the build, which obviously you can ask Brian and he'll talk with myself and our team, and we'll tell you when those points are. But the idea here is that the market goes up, well, you're getting 35 to 40% of the upside of the S&P 500. And recently, because of interest rates, we've actually had builds of these strategies up to 50 to 55% of the upside of the S&P. So because treasuries have done pretty well and they've given good yields recently, now they've come down a little bit, but this has given us a good amount of upside capture. So think about this as the downside is there is no downside as long as you stay in point to point because you're backed by the full faith and credit of the United States government. And then if the market goes up, you get some part of the upside. So this really is a risk-free portfolio as long as you stay invested through the second point. One of the other things that's noteworthy about this strategy is, let's say you get invested and you put $100,000 in this and the market really takes off, goes up 20, 30, 40%. And now your portfolio is worth $115,000 after the first year. You can always pick up the phone, call Brian, and ask him to reset the portfolio. And what we do is we now lift your floor up to $115,000. So now your floor has been raised 15%, and now your new floor is 115. There's no downside capture, and you'll still get 35 to 40% of the upside on the S&P 500. So this is a great strategy if you want a low risk strategy that's looking for some type of growth if the market goes up. And I think it's fair to say that this is a good investment with the market still being well off of its highs, right? We're still not even close to where we were on the highs of the beginning of 2022. So we're still invested at a low point. If the market runs, you'll make some money. If the market continues to drop, you're protected.
Talk about this one here.
Yeah. So this is the ZEGA Treasury income portfolio. And the only difference is here is you're still getting that 35 to 40%, but the difference happens with our baseline. And this is if the market goes down in the first strategy, you would lose zero. But right where Brian's drawing that line, right? We got the S&P 500 again. But what you'll see is the blue line's actually moved up about 2%. So in this strategy is even if the market goes down, you still make 1% per year. And that's what that where Brian's drawing right there, right? Is so instead of having a 0% flat line, you actually are going to make money no matter what happens in the market. You still own U.S. Treasuries. You're just going to make at least 1% per year, net of all costs, and you're going to get some growth out of the portfolio regardless of what happens. The trade-off for that is that we do cap the portfolio at 20%. So listen, that means that the market would really need to take off for you to hit that cap. I don't think we hit the cap over the next 2 to 3 years. But what happens here is, hey, if the market goes down, you still make 2 to 3% over that time frame. The market really takes off, you can still make up to 20%. Right? I think most
an
people,
annuity that gives you a 20% cap, Mike.
20% cap. You're still pretty happy making 20% over the next couple of years, right? I think a lot of people would be happy with that. And again, you can always reset this at any time, right? Market's up and you're up 10% in 1 year. You can always reset it at that point. So the only difference is you just have a cap on the portfolio. But again, the odds you hit that cap, I think, are pretty low.
Absolutely. All right. Man, I love talking about this stuff, man. Okay. All right. Now let's move on to the ZEGA Dividend Plus model. This is one that I really find to work exceptionally well with clients that I put into it. It's been really unbelievable. I also think that how it works is really kind of ingenious as well, because bullet point six, I'm trying to sneak up on these guys. Wish I was better with that. Okay. The ZEGA Dividend Plus portfolio models income is generated from both stock dividends. Write this down. Where's the income generated from? And this is what I find so ingenious about it. It's generated from both stock dividends and option sales at roughly a 50-50 proportion, would you say, Mike? Some roughly around there?
Yeah. The income comes from maybe a little bit more from dividends, maybe a 55-45, something along those lines.
Okay.
But
so here's the basic outline here of how it works. You want to kind of jump on that?
Yeah, absolutely. So Dividend Plus is a great strategy that we've developed over the past year or so. And what it is a very simple strategy designed around covered calls. It's designed to give you about 8% of cash generation to the portfolio. And we do that through a number of ways. The first is that we built out a strategy that's based on what we call the dogs of the S&P 500. And what that is it's the top 1 or 2 yielding stocks across different sectors. So utilities, industrials, materials, technology, and so on.
Dividend yielding, right?
Dividend yielding stocks, right? We're buying dividend yielding stocks in each one of those sectors. We do that by screening through different money managers of the stocks in the dividend portfolios. And then what we do is we sell call options on top of the portfolio. So just think about it as you're buying a dividend stock that pays 4%, and then you're at least getting that 4% dividend. And then we're selling a contract above that stock that's going to give you an additional 4% per year, broken out to about 1% per quarter. So that's the idea, is we're generating income from the dividend, and then we're also generating income from the options contract each quarter. So if you're looking for a portfolio that yields you 8%, this could be a really good solution for you. It's appropriate for any investor looking for income or looking to kind of limit some of the volatility in the market, right? Think about it. If you have a portfolio yielding 8%, and the market drops 10%, well, you're still getting 8% of income, right? So you're still going to kind of build your way back up. So it lowers the volatility. The only thing about this strategy that's a little different than the last one when it comes to minimums is that the minimum's a little bit higher here. We try to at least put in $250,000 in this strategy. It's a little more complex to make it work, but it's a great strategy if you're looking for income or you're an income generating investor.
And to add to that, just the fact that too, it being great for income, because these dividends mostly are generated monthly or quarterly, right? Yeah. And the same with the stock option income as well. So you're getting it spread out across the year. It's not the same as when a stock takes a run at any given time. You could be down half that year and then up, and then you're taking out $1,000 a month, 2,000, whatever it is. But now, when that stock goes to make a run, you got $2,000 less in it than you would have. When these are income driving stocks that produce on a regular basis, they're offsetting each other at the same time you're taking the income. Is that fair to put it like that too?
Yeah, I think what's important to know about this strategy is, when you look for stocks, if you find a stock that yields 8%, 9%, 10%, it's usually a very risky stock, right? There's a reason that they pay such a high dividend. It's because the company may be at risk. There may be additional risks that they're taking on to pay such a high dividend. What we're doing is we're buying better quality stocks to maybe have a 4 or 5 or 6% dividend, and then we're enhancing the dividend with an option strategy. An options overlay is really how you articulate it. So we're overlaying options on the portfolio. It's generating additional income, and we're buying better quality stocks than a stock that might yield 8 or 9%. So think about it from that way, is that you get 2 buckets of income. One is from the dividend, one is from the option premium.
Absolutely. All right.
So yeah, this next slide Do you have anything on this, Brian, or you want me to jump into it?
No, I was just gonna say jump in on it because obviously I like these. I like the slides. They kind of the picture's worth 1,000 words, so to say.
Sure. Yeah. So in this one, the way to read this is the red line is the stock and the blue line is the covered call. So it's owning the stock with a covered call. The nice thing about our strategy is if the stock runs and does well for that quarter, we're not going to limit all of the upside. So when you enter into some of these contracts, what happens is the stock can get called away from you at a much higher price. I'll give you an example. You buy stock at $100, we sell a contract at $120. Well, if the stock runs up to $130, well, you're going to have to sell it at $120, right? That's how the contract works. So you would miss out on the extra $10 of growth, but that's okay. We're okay with giving up that extra $10. The reason why is because we're getting income for our contract and we're not giving up the first $20 in my example. So if a stock went up 20 bucks or 20% in one quarter, I think most people would be pretty happy with those type of returns, right? You'd make 20%, plus you'd make your dividend, plus you'd make your premium from your call option. So the idea with what we're doing is we're not limiting the upside. If you have a good market, you're still going to get a lot of participation. A lot of the other covered call strategies out there, they will limit your upside significantly. We try not to do that.
And I think the only point I wanted to make with this is really just a chart that's representing the value of the stock, not the income that's being generated.
Correct. Well, so what this does show you is the option premium. So that's why the line shifts from the red line up to the blue line, is you immediately make more money than the stock because you're getting paid some premium. So anytime the stock goes down, you're actually better off because of the premium generated. The only time that the stock does better is that they cross your options contract. So you can see you're above the market the majority of the time. It's only if the stock really runs that you need to worry about that.
Absolutely. Okay. So also when it comes to stock portfolio's value, the ZEGA Dividend Plus portfolio also has a theory when it comes to S&P 500 dividend stock as well. And these two graphs here kind of unfold that theory. Want to jump on that too, Mike?
Yeah. So this is what's called the dogs of the Dow, or in this case, the dogs of the S&P 500. And what you're looking at here, chart wise, is the S&P 500 is in it looks like the red, and then the dogs of the S&P are in the black. And what you can see is there's lower volatility. So when the market goes up in that top chart, right, you don't rise as much as the market. So it lags a little bit. So, but that's okay. That's what we're designed to do. Remember, we're going back to that limiting volatility. We're limiting the ups and downs of the market. Because when you look at the chart on the bottom here, is look at the S&P. It really takes a dive. But what happens? We are limiting that with our black line there, and we're having a more stable or more consistent portfolio. So again, this narrows down what we're looking at. And what happens is because you don't have these violent swings of the market up and down, you have more consistent returns. And we tend to lose less in the down market and provide additional value in the down market. And because of those two things, you have a more stable portfolio that equates to better returns over the long run.
Yeah, black being that it's the stocks that the dividend plus is the type of stocks the dividend plus is invested in.
Correct. Yeah, and just to give you a little bit of color on some of these stocks, is these are household blue chip names, right? These are Verizon Wireless, Walgreens, IBM, right? These are solid, big, large cap blue chip companies that anybody would like to own, right? I don't think even if we're in a recession, IBM is going to go out of business, or people aren't going to stop paying their phone bills, right? Especially with the kids these days.
Right.
They're going to be texting and calling and things like that. So obviously everyone's paying the Verizon bill. Walgreens is a great example. People are picking up prescriptions regardless of what happens to the market. So these are our recession-proof stocks. Even if we hit that real negative word out there, a recession, these are still stocks that are going to do fine. They're going to continue to pay their dividend, and we're going to enhance that dividend with the covered calls.
Absolutely. Okay, last one we're going to cover by popular demand because it was so, and we invested the vast majority of people we put in ZEGA was through the high post conservative. So let's just hit on this a little bit, Mike.
Yep, absolutely. So this is hypos conservative. This is the true alternative strategy that we talked about. And I think what's important to understand here is how the strategy works. That line there, it's called candlestick chart. This line here is the S&P 500. What we look at when we have this purple cone here is what's called our probability curve. And what you want to know here is if the market moves or lands inside that probability curve here, Brian, I'll draw with a green line here, is if we have a market that moves here or a market that moves here or even up here, we're fine. We make our 1% because what we're doing is we're selling this strategy down here, right? We are selling in here. So we are selling an options contract below that purple line that generates income. So as long as the market finishes anywhere in here, we're fine. We make our 1% and then we move on to the next month. So we put these contracts on for a 1 month period in our green bubble. We generate our 1%. As long as we finish in our probability curve over the next 30 days, we're fine. Now, where this strategy can have a little trouble is if we move down here below the probability curve. But what we can do at that point is we can reset our line down here to try to hedge or protect the portfolio in a more significant way. So the clear takeaways here are this is a true alternative strategy that benefits from what's called time decay of options. This strategy's never had a down year. It's averaging about 9% a year over the past 5 years. And last year was up 5.8%. So just think about this as an alternative strategy that's not correlated to the market. That's what's important here. This is not predicated on what the S&P 500, the NASDAQ, the Dow, the Russell, the bond market, it doesn't matter what those do. We're just trying to get our 1% every year by trading inside of this green circle down here. That's where the opportunity is. We do that every month. It's a very consistent strategy. And like I mentioned, never had a down year. Sure, we've had some down months, but as long as you stay in the strategy, we've had very consistent returns. Since Brian's getting ready for opening day and he's got his baseball background, I will give you a baseball analogy, which is we are never trying to hit home runs here. We're just trying to hit singles and doubles. If we can do that consistently, you're going to end up with great performance. If you had this portfolio in your, or this strategy in a big piece of your portfolio over the past year, guess what? Part of your portfolio was up last year. And I don't think there's a lot of firms out there that can say, hey, we made money last year, but this strategy did.
Absolutely. I find this probably the most exciting because of the non-correlating.
It's a great strategy. Oh, one more thing I didn't mention. Minimum for this strategy is actually pretty low, which is really neat. It's $50,000. So, you can add this at any time to give you a good diversifier, even if you're, only investing $250,000 or so with Brian and his team.
Absolutely. All right. So we are looking at the grand finale here. Since we now have a much better idea of what thought and strategies have gone into the ZEGA model portfolios, let's take a look at what their performances have been like since their inception up until February of this year, 2023. And I must say, Mike, it still blows me away that the high post conservative up until last year has still not had a negative annual return. I mean, that absolutely still trying to wrap my head around that.
Yeah, absolutely. So I'm going to grab the note here to draw a little bit again. And what we're looking at here, let's go to hypos conservative. Conservatives right here, right? So, we're up 1.3% this year. And like I mentioned, on a 5 years, we're up 9.5%. So again, this is even through those down markets, right? And this is a 1-year look back from March to March. So that's why we're at 4%. But even on a 1-year look back, right, we've had consistent performance and never really had that down year. So great performance overall with the strategy. Now, if I look at the ZBIG Treasury strategies, these are a little bit newer, right? So we're looking at them through this year. We don't have long-term numbers on this, but what you can know is that, right, the market's up a little bit this year, so these are going to be up, right? These are very low-risk strategies, right? We're not trying to really, again, hit home runs here. We're looking for consistent performance, and these are very, very protected. Even our other strategies in the ZBIG line have great performance year to date, and our leverage strategy is actually even beating the market right here. So I know we're not talking about that tonight, but again, that's an more aggressive strategy that also has some protection. So the idea here, when you look at performance, is we want to be consistent. Are the strategies doing what they're designed to do? The answer to that is yes, right? The ZBIG Treasury strategies are protecting. They're getting some upside capture of the market, but if the market drops, they're very protected. When it comes to the hypo strategy, right? Never had a down year, very consistent returns, 9.5% over the past 5 years. And even the income, which we haven't talked about, but it's a little bit more conservative, even more than the conservative hypos. That's never had a down year either, and that's doing 4.5% or 4.2% over the past 5 years. So a little bit more conservative version there. So again, even our most aggressive, which had a really bad year last year, is still only down 1% over the 5-year period. So again, very consistent performance. Our dividend plus strategy, we actually have some performance from last year. It actually was up last year since we started. Again, market down, we ended up, and we're slightly up this year. We're kind of in line with the market. We'll see where things go. So good performance to start the year. It's been a very volatile start, right? January was a great month. February and March, not so much. We'll see how we end with Q1. But if you have these strategies in the portfolio, you've had consistent performance. Again, going back to limiting volatility. You want to limit the ups, you want to limit the downs, and stay consistent. That's exactly what we're doing.
Absolutely. Okay, so these are the resources we use. Most of this actually is ZEGA's website. You can go to ZEGA's website and see all this and a ton more. That's ZEGAFinancial.com. Rachel's going to put these in the comment box. All right, folks. Well, that concludes the educational part of our workshop today. But before we jump into our 6-question quiz and our Q&A for it, I want to make a very special offer to everyone that has attended it. I want to offer everyone here a no obligation complimentary investment plan analysis. And I want to take a minute to explain a little about what's entailed in that and what you can get out of it. Well, first of all, what's entailed in it is, first, there are 2 ways that we can actually meet. The first is online using Zoom, which is almost just like how we're doing this webinar, but instead we'll both be able to see each other and to hear each other privately. Secondly, we could actually meet in our office in Fort Washington. People do that again. I mean, COVID's over, right? I mean, I was just in the office the last month a couple of times, which I haven't been in much since after COVID, but it's pretty cool. Second, it's a 2-step process. First, we would meet to gather some information to do the analysis. Second, we would meet a second time in order to give you the results. Finally, what you can get out of this is a clear understanding of whether it would be worth it or not for you to integrate one of the low volatility protected / hedged investing strategies that we discussed today, or perhaps even some other recommended adjustments, if they can benefit you and your financial plan. So if you'd like to take me up on this no obligation investment plan analysis, Rachel will be posting in the comment box right now. She should be, right? Are you posting it, Rach? A link to a 60-minute Zoom meeting or a 60-minute meeting in person. She's also going to be posting a couple other, if you have questions about it and whatnot, you just want to do a 15-minute phone call that you answer those questions before you book. You can book that as well. All right. You can do it also during our quiz, because they'll be sitting there up in our chat box as we're going through. So if you have any questions, and you'd like to, you'd like to answer it before you book, you can also do the 15-minute meeting. Also, we'll be leaving this Zoom meeting open for a half hour after it ends today, so that you have some extra time to be able to copy and paste any of the information that Rachel puts in that comment box, or anything that goes in the Q&A for that matter, because once we close this, you won't have access to it anymore. All right, here comes the big moment there should we do a drum roll? Our 6-question quiz. Get ready, folks. All right. Question number 1. What is the name of the financial instrument used to protect or hedge investments? Come on, Rachel. Jump on us with this.
All right, we got. Oh, Patsy got it.
What'd she say?
Stock options.
Stock options. All right, Patsy. You're on point tonight. All right. Number 2. What is the first reason, if anybody gets this wrong, right? What's the first reason to use protected or hedged investing? The first number 1 reason.
Oh, and you got it.
What'd she say?
To reduce volatility.
Yes, Angie, awesome. All right, I'm going to throw tactical in that with that too, because it does that too. So, all right, number 3. What's more important, compound dollar returns or average numeric returns? I'm on the edge of my seat, Rachel.
All right, looks like. And fee.
And fee, what'd she say?
Compound dollar return.
All right, Ann, great job. Awesome. These bulletproof. These bullet points. I keep saying bulletproof. Bullet points really work, man. I'll tell you. All right, number 4. Name one of the 4 ZEGA portfolio models that we covered tonight. Just one of the 4 ZEGA portfolio models we covered tonight.
Looks like Patsy got dividend plus.
Yes. Good job, Patsy. Awesome.
Nice.
All right. We're really spreading it out. I mean, isn't Bob on tonight or what? That's not. Okay, number 5. Why do the Z-Big Treasury and Z-Big Treasury Income portfolio models both have the name Treasury in them? Come on. Anyone?
Oh, wait.
Yep.
Oh, yeah. Angie said treasury bonds.
Yes, we're on a roll. We got through the first 5, Mike. Last one.
Yeah, I see that. A couple people got them all right.
Yeah, we're mixing it up tonight, right?
Yeah.
All right. Final question. What is the ZEGA Dividend Plus portfolio model's income generated from? Ooh, it's a little harder.
A little tough one, right? There's 2 things that generate income there.
2 things that generate income. What are they?
Looks like we got a couple answers.
All right.
Yeah, Angie got it. Stock dividends and call options.
Yeah, exactly.
Yeah.
Option sales.
Yeah, good job, guys. That's a great
Good job.
answer.
Good job. Awesome.
This is hard stuff too. You know, sometimes when we talk about it, it can be very complicated. So great job for picking up on everything.
Yeah, great job, everyone. Awesome. I did get a few questions coming in through the email too. So, but if anybody has any other questions out there, we could jump on them first.
Let's see here.
Yeah, and fee too.
Okay.
Great job.
All right. So it looks like first question, are the Z-Big Treasury models principal protected by ZEGA?
So great question. So the answer is yes, they are principal protected. 1, 2, no, not by ZEGA. They are principal protected by the treasury bonds. So you own treasury bonds. These are backed by the full faith and credit of the United States government. So the U.S. government, again, they could fail, right? Technically, right? And the U.S. government could fail. Highly, highly unlikely. I trust the U.S. government a lot more than I trust an annuity company, right? So I don't think the U.S. government's going to fail anytime soon. So they're not protected by ZEGA, but they are fully protected and backed by the full faith and credit of the United States government. So
what's the average duration on them, Mike? What's the average duration on those bonds, maturity?
In 24 to 36 months. So it's always a 2 to 3 year treasury bill that we own there. Again, very short term. It all depends on where rates are and how good of a rate you get. But right, 2 months ago, you got a little higher rate. Right now, you get a little lower rate. But either way, rates this year are a lot higher than they were the past couple of years. So yes, fully principal protected by the U.S. government.
And just a note on that as well is if someone did pull out prior to the maturity of that bond, see, the government guarantees the principal back to that bond at the maturity of it. But if you pulled out prior to, and the rates were, and they're going to be up or down from the time when you bought it, you could end up then being down on
Correct.
that.
Right. So let's say you get in and it's a 24 month or a 30 month or a 32 month or whatever month we are in when we build this. Absolutely right. If interest rates always are ticking up and down, and so if you had an urgency or you just you wanted to pull the money out for something else, you could lose technically if you pull out early. So that's the negative, is if you need to pull out early, you could lose depending on what happens with interest rates. The other thing is you could always make money and pull out, right? So those are market driven. You are principal protected, but if the market's up or down, you could always lose. Now they're very conservative, so I wouldn't say maybe you might be down 1%, 2% tops. If everything went against you in the wrong way, maybe you could lose 3%. But again, if you stay until the end, then no, you're fully principal protected. But yes, if you had to pull out, you could. That's the good thing, right? Emergencies, no surrender charges, no exit fees or anything like that. No.
That's what I was going to say. If it was an annuity, you're getting a market value adjustment anyway, and you're going to get a fee on top of it.
Correct. Yeah, market adjusted value. Right, exactly. So we make everything very liquid, very transparent, very easy. But you could lose if you pull out early, or you could make money. It all depends on the market.
Right. It kind of inherent market value adjustment in a sense, based
Correct.
on.
Yep. Yeah, it's a market value adjustment. Exactly what it is.
Just like annuities do, except for with the annuity, you would also get a surrender fee if you're inside that surrender period, which you wouldn't with this. So
correct.
All right. Yep. What else you got for us, Rachel?
All right, let's see. How about when a ZEGA portfolio is hedged, does that mean that when I check on my portfolio from time to time, it will never have less than the principal amount I invested?
Okay, great question. So the answer to that is no. If you were to put $100,000 in a hedged portfolio and the market went down, there's a chance that you might have 98,000 or 95,000. Yes. So the hedges in the portfolio actually do take time to work. So and it all depends on how tight the hedge is of the portfolio. So if we have a very loose hedge, meaning, we might not hedge until the market drops 10 or 15%. Well, yeah, then you're going to feel that first 10 or 15% to the downside. But those looser hedges have more upside growth, right? Because the looser hedges cost less. Now, if you have a tighter hedge, like a ZBIG Treasury, well, yes, you could still lose if the market goes up or down. So you can always see day-to-day fluctuation. But over time, those hedges really kick in and they really build back the portfolio very quickly. So I will say the answer is yes, you can see day-to-day fluctuation. The longer you're in the portfolio, you'll see less day-to-day fluctuation because you'll have time to build that portfolio with the income generation, the dividends, things like that. So Over time, less volatility. In the beginning, you kind of have a little bit more volatility, but you can, at any time, yeah, you can check and it'll be up or down. As long as you stay in, the hedges usually will kick in and hit your protection level, and your portfolio will stop the down draw, depending on what level we pick, right? Whether it's a really tight hedge like ZBIG Treasury, or it's a really loose hedge, which might be like ZBIG Leverage, which we didn't get into, but kind of has a hedge that takes a lot longer to kick in. So it all depends on which portfolio we go with and how tight we make those hedges.
But by the time you get to the end of the build, what have you, should, if the market's down, you should be back to your principal.
Yeah, absolutely. Even in the ZBIG Leverage portfolio. So even our much more aggressive ones where we have these big buffers built in on the first 25%. Those strategies, which we didn't get into, but those strategies, I mean, the market could be down 20% from where we got in. And you could be down 20% at one point. But if you stay into the second point, it builds you right back to where you started. So your original 100,000 could be worth $100,000 when we get to that second endpoint. So just keep that in mind is, yeah, you might experience fluctuation much more in the more aggressive portfolios, a lot less in the treasury portfolios we talked about tonight. You might experience that. But again, that's why we call those point to point, because over time, the income builds back. That's why you're principal protected in the ZBIG treasuries, and in the buffer, the more buffered versions, the IRA, the leverage, and the standard, those take a little more time to build back up. So again, all depends on how tight we hedge. Tighter the hedge, the less volatility. Looser the hedge, the more volatility. But again, the idea is as we get to the end of that second point, we're always going to be back to at least our principal level if the market is down.
Yeah, between the points, you'll either have more or less volatility depending on the markets, depending on how tight or loose the hedge is.
That's correct. Yep.
Okay. What do you got, Rachel?
All right. How about if a person had $100,000 to invest, how would you advise them to split it up among all of the ZEGA models?
So $100,000, I would say it all would depend on how aggressively you wanted to be invested. And it would also depend on how that money was.
Let me rephrase that a second. If there was no minimums, how would you do it?
Oh, well, again, this would all depend on your aggressive level. But we didn't talk about the other ZBIG models, but the ZBIG models are lower. The ZBIG IRA, standard, and leverage are $50,000 minimums. So again, if you had some type of moderate risk tolerance, maybe I would put 50% in ZBIG and 50% in hypos conservative. If you had a larger account balance, I really think the dividend plus model is really going to be very consistent over the next 3 to 5 years. So I might do really
someone at $500,000, for example.
Yeah, at a little bit higher level, I've seen what we've really been doing a lot of is 80% in dividend plus and 20% in hypos conservative. So it all depends on your risk level, and that could be 60% in dividend plus, 20% in hypos conservative, and 20% in ZBIG treasury, right? If you're a little more conservative, we've done that as well. The idea with a lot of these strategies is we've seen volatility happen in the market. We don't know what's going to happen over the next 3 to 5 years. So what we've done is we've created strategies that generate income regardless of market conditions. So if the market's flat, our idea is that we're going to make you a little bit of money. Maybe it's 2%, maybe it's 8%, maybe it's anywhere in between. But if I'm thinking of a bigger account, I'm using dividend plus and hypos conservative. If I'm dealing with the smaller accounts, I might use a ZBIG strategy paired with hypos conservative. Both of those routes are going to look pretty good over the next 3 to 5 years.
Nice. One last one. I think we time.
Yep. There is one more one here. It says, would I be better off in an annuity with an income rider or in one of the ZEGA income model portfolios?
I think we answered that. But what's your
look, I'm a little biased towards ZEGA, obviously, right? I'm rooting for the home team here. I'm sticking with the baseball analogies, but I think that it all depends on what your risk tolerance is and what you're looking for, and liquidity. Our goal is to always provide liquidity for our clients. So whether you're invested for 2 days, 2 years, or 20 years, you always have access to your money when you're invested with ZEGA. If you want to be conservative, we have strategies like ZBIG Treasury and ZBIG Treasury Income that compete with annuities. regularly. Even ZBIG IRA and standard and leveraged as well compete really well with annuities. They are deconstructed liquid annuities. That's what we've built with those strategies. So we've designed them to really compete with annuities. So my thought is you're better off investing in one of the ZBIG strategies because you're going to get very similar structure to annuity, but you have daily liquidity in those strategies and you're never going to get locked in.
I just want to add one thing to that as well. And, you know, listen, I've sold many annuities with income riders. Well before being introduced to ZEGA. And one of the things, having lived through, you know, the two, that's got me leaning more towards ZEGA, besides the surrenders and all that kind of stuff, which are really, can really be a bummer, right? Especially right now with the market value adjustments, you know, because the bonds have gone up. So people are getting hit a lot harder with their market value adjustments. But also the fact that all the annuities that I've sold, they have point-to-point indexing strategies, and they're annual or biannual. And so if you're drawing, I just feel more secure when I know a portfolio is generating income frequently versus someone drawing off an investment for a whole year before they're getting credited. And sure. I know the impact of that, and it can wear, especially, you know, especially if it's non-correlating. And in some ways, only under extreme situations, the dividend plus concept, the income part is it's not completely non-correlating, but it's somewhat non-correlating from the actual values, right? Because
I would agree with that. You know, I think that goes to income today is worth more than income generated tomorrow, right? So that's the idea of the portfolios, is all of what we're investing in, most conservative, dividend plus, ZBIG treasury income, and even all of the ZBIG strategies are income generating investments, right? We're constantly producing dividends in those portfolios. The standard leverage and IRA are monthly, and then the treasuries are biannually.
And option income, right? More frequently than annually, right?
Correct. Yeah. I mean, even a ZBIG treasury income, you get option income immediately, right? So day one, we're going to give you an option income. So
better to get paid by someone else's money than yours right away, right?
Right. And I just think the income generation, especially in dividend plus, that is a cash cow. It just constantly generates income on a monthly basis. You know, you get your dividends, they're constantly coming in throughout the quarter. Your options income's coming in. You're just constantly generating a bunch of income. We recently had a couple accounts that had so much extra income, we had to figure out a way to reinvest it. So income generation is going to be key over the next 3 to 5 years, regardless of where you are in your retirement or in your working life, right? As you build your nest egg, as you build funds, income is going to be key. You will see that over the next, I honestly think probably the next decade, but at least the next 3 to 5 years. The more income you can generate, the better off you're going to be, especially in your IRAs or taxable accounts even. But IRAs are going to be great to generate income from. So income now is going to be worth more than income later. So take the income now and take the liquidity now. I think that's important as well.
Absolutely. So on those 2 points, just my opinion at the moment, being introduced to ZEGA much more recently than the annuities with income riders, I'm favoring the income now.
Sure, absolutely.
All right, folks. Well, that concludes our workshop for today. I just want to thank everyone who attended for being the type of people that care enough about themselves and their family to spend their precious time learning about important topics like this. I truly commend you for that. I want to thank our very special co-host for today's webinar, Mike Puck from ZEGA Financial. It's been an absolute pleasure having you educate us on these protected/hedged investing concepts, because it's such an innovative and little understood method of investing that certainly could be a big part of so many people's financial portfolio success if they knew more about it. So Thanks again for doing this and for committing to doing a series of these with us, Mike. I just can't thank you enough, buddy.
Yeah, I really appreciate the time today, Brian and Rachel. It's great being on here again. I love always talking to your clients and talking about investing in this series. I think options really should be a part of everybody's portfolio. I mean, I think we've shown some unique ways to invest in these strategies that can make you money even in a down market, right? That's the idea. That's what we're looking for. So I think we got a lot of value. If you have questions, obviously reach out to Brian and Rachel. If you need to dive real deep into a strategy, they can always get me on the phone to go through a Zoom or a phone call with you. We're happy to help in any way we can. So thanks again, Brian and Rachel, for having me.
Awesome. Thanks, Mike. Also, on behalf of my beautiful, wonderful partner in business and life, Rachel Dougherty, say bye, Rachel.
Everybody.
And myself, Brian Dougherty of PLC Financial Solutions, located in the Fort Washington area. I want to remind you that if there's anything we've discussed tonight, or anything else for that matter, that you would like to discuss further with us, you can reach out to us at either 215-804-9708 by phone, or at info@plcfs.com. Or to make it even easier, just go to our website at plcfs.com, and all our information is always there. Also, please mark Tuesday, April 25th, 2023 at 7 p.m. on your calendar for our next webinar. We do them on the last Tuesday of every month. Have a great end of your month and a tremendous April as well. And we'll see you then. Good night, folks.
Hey, guys.
Night, everybody.